Good day, ladies and gentlemen. My name is Kingsley Williams, and I'm going to discuss a few considerations and implications when investing offshore. Satrix Managers is a registered and approved manager in collective investment schemes, in securities, and an authorized financial services provider in terms of phase. So let's firstly understand how to think about equity markets in a global context. So when we talk about developed markets, these are countries like the US, the UK, Japan, Switzerland, and various other markets across Europe, includes Australia, Canada, etc. These are markets which are typically characterized by higher GDP per capita, as well as more developed financial systems and regulations to protect investors. Now, the index which typically is used to represent developed markets or developed equity markets is known as MSCI World. And MSCI World will give you exposure to both large as well as medium or mid-sized companies across the developed equity market universe. Another very popular market, which is often referred to, is the S&P 500. And this index captures the largest 500 companies in the US. So it's going to exclude the other developed market countries, such as the UK and Japan. And it's also going to exclude the medium or mid-sized companies within the US. Now, the US makes up about 64% of MSCI World, if you look at it through an MSCI lens. So S&P 500 would represent a significant portion of the performance of what MSCI World delivers. Another index which is often mentioned is the NASDAQ, and in particular the NASDAQ 100, which also limits itself to large companies only, the 100 largest companies. And specifically also limits the companies that are included in this index to those that are listed on the NASDAQ exchange. So it won't include any companies, for example, that are listed on the New York Stock Exchange, which the S&P 500 would consider and include. Very importantly, the NASDAQ 100 also excludes financial companies. So those won't be represented in the NASDAQ 100 index. Now, we've spoken about developed markets, but there are also emerging markets, and MSCI Emerging Markets is one of the very popular indices used to represent emerging equity markets. Now, China makes up about 40% of emerging markets, and emerging markets also, MSCI Emerging Markets also cover both large and mid-cap companies. When you combine developed and emerging markets together, you get, in MSCI terminology, what they call the All-Country World Index, or commonly abbreviated as ACWI. So any index that has ACWI on the end of it typically would have exposure to both developed and emerging market countries. Now, South Africa sits within the emerging market classification, and within emerging markets, it makes up about 4% of that index. So it's relatively small. In fact, it's only the 6th largest country within emerging markets. And if you consider South Africa within the all-country world index universe, it in fact only makes up 0.5% of the market capitalization of that entire investable universe. So you can see how much more there is outside of South Africa relative to what we have exposure to locally on the JSE. Finally, one last piece of the puzzle are the small cap companies. And these add, these companies are even smaller than the mid-cap companies. They're excluded from MSCI World and MSCI Emerging Markets, unless you see an index which has the abbreviation IMI on the end of it, which stands for Investable Market Index. So if an index has MSCI Emerging Markets IMI, it means it includes large, mid, and small-cap companies within its coverage. Now, Satrix offers a range of international funds through a variety of different product types. So ETFs and unit trusts are available locally in rands. You can access these offshore strategies by investing and redeeming and withdrawing in rands. whereas a UCITS fund is an offshore domiciled fund in Ireland in our case. And so you'd have to externalize your rands into some other currency like dollars or pounds in order to be able to access those funds. So we offer MSCI World and MSCI Emerging Markets as UCITS, but then we also offer MSCI World as both an ETF and a unit trust. So you can access it through either of those vehicle types. Other strategies that we offer in rands as ETFs are MSCI Emerging Markets IMI. So that tells you that you get exposure to large, mid, and small cap companies. And in addition, we offer US exposure in the form of S&P 500 as well as NASDAQ 100. Now, it is claimed Einstein said, compound interest is the eighth wonder of the world, and he who understands it earns it, while he who doesn't pays it. Now, associating a finance quote with Einstein conveniently places those in the investments and finance industry in the company of an undeniable genius. But I'm sure we'll all agree that it's giving financiers way too much credit to associate in the company of such a genius. That said, compounding is powerful, so let's understand why. What difference does 2 to 2.5% make? It turns out quite a lot. 2 to 2.5% is the average dividend yield of these two indices, in this case S&P 500 and MSCI World. And over a 21-year period, it's the difference between doubling, i.e. going from 100 to 200, as you can see on the chart on the left here, by not reinvesting dividends, as shown, versus tripling your money, which is going, say, from 100 to 300, as I've shown on the chart on the right. So when investing, make sure you tick the box to reinvest dividends. Or if you have to do it yourself, make sure you do indeed do that. I am only going to consider total return indices, i.e. dividends reinvested, in the subsequent slides I'm going to show you. When I show you these cumulative charts, like I've shown you on this slide, I'm also using log scaling. So what that means is that each grid line here represents a doubling or a halving in value in terms of market movements. And it's important to do this log scaling because if you don't, what happens is the earlier moves become smaller and smaller relative to the later moves because of compounding. So what you can see on this chart is that these indices went from 128 to roughly 64, which represents a halving of value, i.e. losing 50%, and then back up again to this level, which represents a doubling, i.e. 100% gain. And the same from here to here, that represents 100% gain. So important to bear that in mind. I'm going to move on to gross total returns of various indices in dollars. And I'm just going to take you through what the NASDAQ 100 has done all the way back from March 1999 to present day. So I'm not sure if any of you can remember the tech bubble, but the NASDAQ 100 was probably most exposed to it bursting. I had just actually started working in the early 2000s and was very fortunate to be based in New York City during this time. So when the dot-com crash started unraveling, the following year, I was actually in London, and then 9/11 happened, which obviously didn't help any further. There was a slight recovery post 9/11, but markets ultimately continued falling for another year since 9/11 and bottomed out in sort of September 2002. Now, if you look at the performance from the peak of where the NASDAQ 100 was to its low in September 2002, it lost over 80% of its value over that period of time, which is a staggering outcome, particularly considering that when we look at the NASDAQ more recently, it's really only been going in one direction, and that's up. Let's look at some broader indices such as S&P 500 and MSCI World, which fared better, but actually still lost half their value during the tech crash. And 4 years later, after all the losses had been undone, that we then were faced with the global financial crisis, which struck as the overleveraged housing market ripped through the banking industry and financial markets. And so those again lost, these indices again lost half their value, while the real economy slumped and job losses mounted. Now, post the global financial crisis, or in response to the global financial crisis, we became familiar with the term of quantitative easing or monetary stimulus. And post that, we have experienced one of the longest bull markets in history. The US in particular has done very well over this period, with the S&P 500 catching up and surpassing developed markets, which is the dark blue line more broadly, while the large cap and growth stocks outperform small and value stocks, resulting in the NASDAQ 100 significantly outperforming the broader US market. So you can see the light blue line being below the S&P 500 and MSCI World, but ending up significantly higher at the end of this period in April 2020. Perhaps surprisingly, emerging markets have done even better over this entire period relative to developed markets. And this has largely been due to their performance before the global financial crisis, as developed markets have outperformed since then. And you can see that outperformance since then with the narrowing of the gap between developed and emerging markets. Perhaps what's most surprising, however, is how South Africa, in dollar terms, so there's no currency effect here, has outperformed all of these indices. Again, largely due to phenomenal performance pre the global financial crisis. And this is despite our depreciating currency and the largely sideways moves in local equity markets, which we've experienced of late. You can see this green line not really going anywhere. I'm going to add one final series, and that's to show how the dollar has performed relative to the rand. So think of exchanging $100 back in March 1999. This is what those $100 would be worth in rands. And what you'll notice is that the rand tends to weaken during financial distress and then recovers again when equity markets recover. However, over this entire period, it is weakened relative to the dollar by an average of about 5% per annum. Now, the rand is considered to be very undervalued at the moment. You can see it's weakened again. So there's a good chance it could strengthen from its oversold levels, as has happened in the past. And in fact, we have seen that occurring in May, which is post, after the point that I've plotted in this chart, with the rand strengthening quite significantly this month. I've moved that chart onto the left. It's the same chart. And I'm going to now create a similar chart by converting all of these dollar returns into rand. So the first thing you'll notice is that with the help of a weakening currency over this period, all the indices are boosted in rand terms by multiplying the index performance in dollars on the left with the currency performance, which is the black line. We get the performance in rands on the right. So over the 21-year period, these indices have increased between 8 to 15 times, with an average annual return ranging from 10.5% to 14%. And again, this is all before costs, which is quite a staggering result. I emphasize before costs because, as you'll notice in the footnotes at the bottom of each slide, you cannot invest directly in an index. When you access an index tracking fund, there are obviously costs involved, and your return experience may be different from what the index is showing here. But to the extent that you can track these indices closely, they have delivered phenomenal returns over a long period of time. So also, just to re-emphasize, whether in dollars or in rands, the South African equity market has outperformed all of these indices over this 21-year period. However, despite the amazing returns over this long period of time, humans, as humans, we are prone to what we call recency bias, and emotions tend to take over in the midst of turmoil like we've been experiencing over the last few months. That said, looking at shorter period returns can be useful to understand the consistency of your investment experience and also highlight what shorter term risks there are. So on the next chart, I'm going to plot the rolling 3-year annualized returns of all of these indices in rands now. So have a look at the NASDAQ. The first point will only be in March 2002 because it requires the first 3 years worth of monthly returns in order to calculate that first 3-year annualized return. And you'll notice that with these 3-year returns, even on a 3-year basis, there were significant periods where an offshore strategy investing in something like NASDAQ 100 would have delivered negative returns, even on a 3-year basis. So at each of these monthly points, looking back 3 years, this is what your average 3-year return would have been. And at its worst, it would have been close to minus 35% on average per year. So bear that in mind when investing in equities, that they do come with a very healthy risk warning, and even more so when you invest offshore, as there is a currency risk that also applies. So I've added all of the other series. I'm not including any of the dots because the chart gets quite messy. But what you'll notice is that with the South African market in Rand terms, relative to the other indices also in Rand terms, our local equity market has only had 1 point where it's delivered a negative return over 3 years. And that, in fact, occurred in March 2020, at the end of the first quarter, when the COVID-19 pandemic really hit global markets and there was massive uncertainty on what the impact of that would be. You can see markets have recovered on a 3-year basis since then, back in positive territory. But bear this in mind when considering an offshore strategy relative to a local strategy, that there are additional risks involved with investing offshore, particularly brought about by the currency. Moving on to the constituents of these indices, I'm looking now at developed market index constituents as per MSCI World, starting with the largest 20 names within MSCI World. I've also included the country, and you'll see that it's dominated by the US. But it's important to note that a lot of these companies, while they may be primarily listed in the US, be domiciled in the US, they are essentially global companies. They service customers around the world, as you can see with the names in this list. Have a look at the size of the company. Some of these are in excess of $1 trillion, absolutely staggering in terms of how large these companies are. And then what I've done is I've plotted the or shown the weights of each of these companies within various developed market indices, such as MSCI World, S&P 500, and NASDAQ 100. You'll notice as you move from left to right that some of the names and companies aren't included in indices as you move to the right. And that's obviously because S&P 500 is only going to consider US companies and not Swiss companies. Similarly, with NASDAQ 100, it excludes companies listed on the New York Stock Exchange as well as financial companies. So a lot of the US names aren't going to be included in the NASDAQ 100 because they're either financial companies or are listed on the New York Stock Exchange and not the NASDAQ. One final point to note is the top 20 weights at the bottom here. So this is the top 20 weights of each index, even though I haven't shown all top 20 names for each index. The cumulative weight of those top 20 names is plotted at the bottom here. And you'll notice that as you go into a narrower, more concentrated index, this number increases as you move from left to right. You'll also see that the weight to the largest company increases as you move from left to right. So really diversifying one of the great things you can do in investments is to diversify away stock-specific risk. And you can do that very easily by going into broader indices such as MSCI World. But bear in mind that if you target more niche exposure, it does come with more stock-specific risk. Moving on to emerging markets, and what stands out for me here is just the far wider representation from a country perspective. You see China, India, South Korea, Taiwan, and Russia represented in the top 20 largest emerging market companies. You'll also notice that some of the emerging market companies are large even in developed market terms. So if I flick back a slide, you'll see the 20th largest company within MSCI World is Pfizer at 212 billion. Back to emerging markets, and you'll see the 3 largest companies are actually larger than that 20th largest company within the developed market. So that's quite interesting. As I mentioned, China makes up about 40% of MSCI emerging markets, and you can see the companies represented there. I've also included the FTSE JSE All Share weight, and we only have one company represented in the top 20 list, and that's Naspers, as a result of its holding in Tencent, which is the 2nd largest company within emerging markets. What's interesting to note, though, is that there are other large businesses within the All Share that aren't shown here. because they are, from an MSCI perspective, actually classified as developed market companies. They have their primary listing in Australia in the form of BHP Group, Switzerland in the form of Richmond, Anglo-American and British American Tobacco have their primary listings in the UK. And these are large developed market businesses which you actually get exposure to when you invest locally across the JSE. So while the weight of the top 20 companies at the bottom here within South Africa may seem really large, this is actually not unusual for single country markets. In fact, even a large market like Switzerland, its three largest companies, Nestle, Roche, and Novartis, actually make up over 50% of their local equity market. Whereas in South Africa, it actually takes 6 companies within the all-share index to reach a similar degree of coverage. Just having a look at how MSCI World does as an investment strategy relative to any other investment strategy you may be considering to get exposure offshore. This is plotting our World Equity Index feeder fund, which is a unit trust, relative to the global equity general category of unit trusts as provided by Morningstar. And what you'll above each of the blue bars, you'll notice a number, and that number represents the rank of that fund over the period. So if we look at on the right here, our MSCI World Equity Index feeder fund delivered 13.36% per annum on average over a 5-year period. It was the 8th best performing fund out of 35 funds available in South Africa offering global equity exposure. The median performance is essentially the mid performer across the range of 35 funds. It would be the 17th best performing fund, and you can see it significantly our MSCI World Index Tracker after costs significantly outperformed the median within this category over all periods. Finally, Satrix is a very broad business. We offer a wide range of investment strategies. You can essentially see us as a one-stop shop for any index tracking requirements you may have to gain exposure to various segments of the market and various asset classes. We run a wide range of strategies, 40 different indices. We invest in 45 different markets worldwide, offering exposure to developed markets, emerging markets, as well as a range of asset classes in South Africa. And our AUM, or assets under management, is in the 90 to 100 billion range. So the business has significant scale and is very able to serve all of your investment requirements. Thank you very much for your time. I look forward to responding to any questions and engaging with you further.